Today we've got Shawn KinCannon with Red River Title, and he is going to talk to us today and educate us about closing disclosures, which everybody can learn more about because it's just so confusing. So
we'll see.
Here we go.
Well, thank you, Randy. Thank you for the applause. I hope everyone's having a good day. I can't see who all is at Paragon in there, but hello, everyone in there and everyone else too. So Michelle asked me to go over closing disclosures, or really going over reading closing disclosures. You can see the PowerPoint, right, Will? Everything's up and ready? Okay, cool. All right, so I'm going to go through reading and looking at a closing disclosure. If you have questions, you can pop them on. Someone's monitoring to get my attention to answer a question as we go. Again, I'm Shawn, Red River Title. All the people I can see I already know, so that's great. All right, so we'll start with real quick with which way is to change the button? Can you hear me now? Is that better? Hi, Peggy. Can you hear me, Peggy?
You gotta say it real loud.
Like
You gotta project.
Am I projecting well enough? Stuart, can you hear me? Give me a thumbs up if you can hear. Where's the other participants? Simone, can you hear me? Peggy, can you hear me now? Is that better? Okay. All right. Well, a real quick introduction. For any of you, which I think a lot of you on here, obviously we're doing closings before 2015 when we had good old HUDs, right? Which everyone hated when we had them and everyone misses them now that they're gone, right? So the Dodd-Frank Act passed. Before Dodd-Frank, lenders were regulated by RESPA. RESPA had what they call TILA, or Truth in Lending Act requirements. So it really was this is a better disclosure system. It is longer and may seem more confusing, but I promise you it's actually better. The closing disclosures are. It's just the format really threw people for a loop because it was so much different than the HUDs that we were all used to. Ultimately, HUDs, the CDs are better than the HUDs. Sorry, I hear a dog barking. I want to see the puppy. All right. So anyway, that's the quick history. Well, I already said what you see on the next slide. So I'm going to skip past. I'm hitting the wrong button. Sorry. Come on. There we go. All right. So I'm going to skip past that. We just talked about it. Closing disclosures are used on all traditional mortgages. The exceptions to using closing disclosures are what you see right there: home equity lines of credit, reverse mortgages, personal property, mobile home loans, and commercial loans. So if you have a client or you have a transaction that has a commercial buyer, or it's a commercial property, elderly people can use reverse mortgages for purchases. So that would still apply. Or if you're representing someone that's doing a home equity line of credit on their home to pay cash, those would be outside of TRID, which means you'll see HUDs on those transactions. But just as a little reminder there. All right. So the first thing that your buyer sees after you're under contract from the lender is a loan estimate. The loan estimate is referenced at closing a lot of times. When a buyer says, well, my lender told me I was going to bring 12 grand and you got 11 or you got 14. A lot of times they're looking at that loan estimate. And at this point, now that we're 6 years into using closing disclosures, most lenders are sophisticated enough where they just over disclose the heck out of those loan estimates. So I'm not a lender, but I would venture to guess probably 9 out of 10 times, maybe 9.5 times out of 10, the final closing disclosure is going to have a lot lower down payment than the loan estimate. But that being said, a loan estimate has to go out from the lender 3 days from the executed contract. So they've got to get that out to your client. Your client needs to look at it, acknowledge they've seen it, along with the millions of other disclosures they're going to get in the process. But that one, nothing goes forward if that loan estimate is not issued quickly. So loan estimate does come from the lender. And you'll see a business day, Saturdays for the most part, count. That also counts for the closing disclosure days as well. So we'll get to that in a minute. This is an example of a loan estimate. So you'll see, and if you're able, and after this class is over, I'll email out this PowerPoint so you can zoom in a little better. But you'll see the general facts of a loan estimate or of the transaction on the loan estimate. So you're going to see the sales price. I get calls from agents that say the loan amount doesn't match the third-party financing. Is that a big deal? It's not a huge deal to me. Usually not a huge deal to lenders until we get to the closing table, where that's where you see us have that initial day closing sometimes. So the main thing is the purchase price correct. You do need to look at the loan estimate to make sure the interest rate or the type of financing matches your third-party financing. So that's where it's important for you to see it, even if the lender doesn't send it to you, because you want to make sure you're following the third-party financing that you guys executed with the contract, and that a seller doesn't call you upset that says, you told me your buyer's doing conventional and now we're doing FHA financing and we're 15 days into this. So you want to make sure everything matches your pre-qual letter with your lender or whatever you prepared the seller for on that third-party financing. So anyway, that's a first page of a loan estimate. There's the second page. You'll see that it does look a lot like, but not exactly, what a closing disclosure. That's a page 2 and a page 3. Again, this is an example and it's incredibly over disclosed. Just get used to a loan estimate. Don't freak out. Buyer's paying for the title policy. Buyer's paying for the survey. Buyer's paying for a home warranty when you know the contract has the buyer or the seller paying for all those things. Don't freak out. It's just an estimate. The lender's going to CYA themselves by overestimating those every time. Okay. Main thing is that interest rate, because it is the loan they're applying for though. So is that interest rate what your buyer was expecting? Is the type of financing what your third party financing addendum has? So anything to add to that?
That's right.
Cool. Brandy's next to me. You can't see her, but she's next to me. So we're moving along quickly. This is easy. You guys don't have any hard questions yet. Let's keep it that way. I'm just kidding. All right. So let's get to the closing disclosure. All right. I said the closing disclosure form is new. I did this PowerPoint a few years ago. It's 5 pages long. Again, for the old timers, Donnie Neal's in here. There used to be a truth in lending signed at closing. That's gone. Obviously the HUD, really this form combines that. And let me just tell you, for anyone that closed with that had a truth in lending in your loan package up until 2015, it was a emergency brake pulled by a buyer so many times. And it was very alarming for a buyer to see that truth in lending. Well, it didn't go away, but because this closing disclosure form is so much better, it is so much less intimidating for a buyer. So again, anytime you get discouraged looking at a closing disclosure, just know the alternative sucked. Sorry, excuse my language. All right. The lender does provide the closing disclosure. So they have to send an initial closing disclosure at least 3 days before closing. So if we're closing Thursday, your buyer needs it Monday. If we're closing Friday, your buyer needs it Tuesday. If we're closing Monday, your buyer needs it Wednesday. If we're closing Monday, your buyer needs it Thursday. If we're closing Tuesday, your buyer needs it Friday. So again, if you didn't catch that, Saturdays count. Some lenders, credit unions, don't count Saturdays, but you'll just have to play that as a case by case. Now, yes, thank you. Federal holidays also do not count. So last 2 weeks ago, Columbus Day wouldn't have counted. Now, a closing disclosure. Sorry, someone in here is running their mouth. Some young punk. Anyway, the initial closing disclosure that your buyers get, okay? Also, don't be alarmed if you see irregularities or issues with that closing disclosure, because that may not be the final one. There are a lot of lenders, Guild included, a lot of lenders that do strive to get the final one out for that 3 day time period, but that 3 day is the CD they have to get out just so we can close on that third day. Okay. So again, you see that closing disclosure and you see some issues with it. Don't be afraid to reach out to title. Don't be afraid to reach out to the loan officer. That's perfectly fine, but just know it's usually not the final one. I know, speaking for us and most other title companies, and speaking for Michelle and Gil and Brandy and everyone there, typically they tell you, hey, this is the initial. Don't get your cashier's check yet, though. We'll follow up with the final. So when it comes to the final closing disclosure, that may actually come from us, the title company. Sometimes it comes from the lender directly to the buyer. Most lenders send the final CD, or the initial and the final, directly to their client, the borrower, and they don't always, if ever, copy the agent on that. So to be clear, the final closing disclosure is prepared by the lender in conjunction with the title company, which we'll talk about in a second. But the final closing disclosure is prepared by the lender and is issued by the lender. You may receive it from the title company. As a realtor, you may receive it from the title company, but it is prepared and sent to the borrower by the lender. As a sidebar, as most of you all are well aware, wire fraud is really terrible right now. As a title company, we made the business decision to not send a closing disclosure directly to a buyer without being requested to do so, either by the buyer or by the agent, only because they get so much stuff and we try to minimize what they get and also not trigger too much traffic that may even end up being something that's not supposed to be. So we limit that. We will send it directly to your buyer if you want us to, but we always make a habit of sending it, hey Stacy, sending it directly to the buyer's agent. We send it to you guys when we get it, by the way, too. So if you get it 10 minutes before closing, it's because we got it 10 minutes before closing. I'm not looking at Brandy. Sorry. No, I'm just kidding. Most lenders are really good about that and getting better all the time. So, all right. Any questions so far? Will, you see any questions? We good?
We're good.
Okay. I'm going to talk about probably 5 years into closing disclosure, still one of the most common, biggest questions I get before I show you the actual closing disclosure. In Texas has what they call a simultaneous issue credit. In other words, if a loan policy and an owner's policy are being issued simultaneously, which anytime you have a transaction with a seller paying, or it doesn't matter, he's paying for the title policy, but you have a standard contract where a title policy is being issued to the buyer and the buyer is getting a standard mortgage loan. Okay. That's two policies being issued by the title agent for that transaction, one to the buyer, one to the lender. Texas tells us to issue what's called a simultaneous issue credit. Okay. Now, I asked this question in 2014-15 when we were converting to these disclosures. Why are we doing it the way we're doing it, which I'm about to show you? The best answer I got is that Texas was in the minority of states where it's customary for a seller to pay for a title policy. The majority of states in the United States, it was more customary for the buyer to pay for a title policy or abstract or whatever it was. So when TRID was creating these forms and Texas said, hey, the buyer doesn't pay for the title policy here, they said, well, let's do it this way, the way I'm about to show you. So it is very confusing. It is still confusing, and it'll probably stay confusing as long as the seller pays for a title policy and TRID doesn't change anything, which I don't expect it to. There's nothing to cause it to change anytime soon that I'm aware of. So the simultaneous issue credit says, well, just so you know, a mortgagee policy, the fee for the premium is actually based on the loan amount, okay? The owner's policy premium is based on the sales price, okay? Those premiums are independent of each other, even though they're gonna be issued simultaneously. So Texas says, instead of charging $1,800 for an owner's policy and $1,600 for a mortgagee policy for the same property with the same parties, you can give a discount to the loan policy where you issue it for $100. Okay. So on a simultaneous issue, the owner's policy is still that full amount. So if you have that policy chart, if you have our app and you see how much the owner's policy is, that is what it is. The mortgage policy should be $100 when it's all said and done. The lender has some endorsements, which we'll talk about in a second, but the mortgagee policy is $100. However, TRID tells lenders you need to disclose and you need to charge buyers the full mortgagee amount. Irregardless of the discount your state gives, you need to charge your buyers the full amount. And we'll get to an example and it'll make more sense when I show it to you. So many times I get a call and the buyer's agent says, hey, my client, the buyer, is paying for the title policy on page 2. The contract says they're paying for it. And I say, haha, go to page 3 and you'll see a credit, which I'll show you here in just a moment. But just know that the lender is disclosing it that way because they're regulated to do so. So they don't have a choice, right? Your buyer is going to get the credit if the seller's paying for the title policy. Your buyer's going to get the credit, and I'll show you how in just a second. And then I have on there, if you know your policies, look on your pocket, premium sheet. If you need one, we got those. Obviously, the app too. For the young kids in the room that don't know what a pocket premium book is. All right, so as the example we're going to get to, the sales price is $175,000, which set by the state, the title policy premium will be $1,227. The loan amount is $167,651. The full premium is $1,189. So without Texas telling us as title agents to give that credit, we theoretically could charge those two policies in full to the paying parties per the contract and make all the money, right? But Texas says give that credit. So you'll see in the following example that there has been a credit given to the buyer from the seller. Again, assuming the seller's paying the title policy, you'll see a credit to the buyer for all but $100. Okay. And then you'll see a charge for $138 to the seller. Again, it'll make sense in just a second. Here is a closing disclosure. I can send out this PowerPoint when we're all done, or have Michelle or Brandy, someone send it out. And I can also send out, here we have hard copies of the closing disclosure that is on the PowerPoint. So you can look at the hard copy if it's easier to read, but I can send out the example of the closing disclosure I have after the class is over too. Okay. So on the first page of the closing disclosure, you'll see some important things that if you're the buyer, and by the way, buyer's agent can get the buyer CD, seller's agent gets a seller CD. So to make this all more confusing, title policy surveys, home warranties, you only see one side of it. As an agent, you only see your party's side, but I'll tell you how you can get around that in a minute. All right. If you're the buyer's agent, you just received this closing disclosure from the title company. What does it say? What am I looking for? Well, you're looking for, are the parties correct? Okay, good. They are. Is the property correct? That's all in the top section at the top. You have the buyer's name, you have the seller's name, you have the lender, you have the title company, you have the property address, you have the sales price. The only thing I don't like is how small the sales price is, but it's there. It says sales price. Did you guys, just like anything else, did you guys do an amendment that someone forgot to send the title? Because this says 175. Y'all did an amendment for 173. Hit the brakes, make the calls, right? But anyway, there you go. There's probably not a lot for you to do as a buyer's agent on the loan terms other than say to your buyer, did you look at that? Is that what you're expecting? Is that what Gil told you? Are you prepared? Great. Most good lenders, including Guild, they have prepared their borrower. They went through the loan estimate 3 weeks before. They saw the initial closing CD. They've seen the final. They're there. But as a buyer's agent, look at it. Loan amount, interest rate, principal and interest. Those no's you see under loan terms, those are things you want to see as a buyer's agent. All right. Can the loan amount change? No. Can the interest rate rise? No. Can the principal and interest rise? No. Is there a prepayment penalty? No. Is there a balloon payment? No. On the old HUDs, on the old closings, lenders used to be able to sneak that stuff in there. Or maybe not so much sneaking in there. Maybe they kind of pulled the wool over their buyer a little bit and they weren't aware they were signing up for this stuff. It wasn't so clear when their interest rate changed before TRID. So this, you're seeing right here on the first page, the reason this form even exists. We're going to get rid of buyers not knowing their interest rate is automatically going to go up 3 points in 2 years. Okay. Or if you were looking at an example where it did go up, if they voluntarily have signed up for an adjustable rate mortgage, it was very clear in big bold letters what it was changing to in 3 years. Whereas the old form just said, it's going to go up in 3 years and we'll tell you how much then. I mean, that's really how nefarious it used to be. Yes, that was the other thing. There used to be, and there still is in a closing package, an initial escrow disclosure that says, here's how much your escrows are. But there wasn't necessarily in a payment letter, but there really wasn't anything necessarily saying, here's your total expenditure each month on this house, not including utilities. So when you go to the next section, you'll see, first of all, this one has mortgage insurance. Your buyer knows right there at closing when their mortgage insurance falls off. If it's FHA, that'll say 1 to 30. And the amount you see on the mortgage insurance in that section, whether it's this example or FHA, is the most the mortgage insurance is ever going to be, which is usually the first year. So in this case, the mortgage insurance is $33 a month for 8 years, and then it just falls off when year 9 starts. Okay. But your buyer knows right now how long they have mortgage insurance. The old one, same thing. It was kind of hidden in the fine print. So in that section, projected payments, you see the same principal and interest you see right above there, $684. You see mortgage insurance for $33. Estimated escrows, well, right there it says estimated escrows, $283. Total payment, $1,001.07. That's how much this total payment is with everything rolled in for your client, for the buyer. Okay. The next one, estimated, or this estimate includes that $283 that you saw in that box above. It says right there, property taxes, yes. HOA, or excuse me, homeowners insurance, yes. If this property has flood insurance, you'll see another box. If it has a homeowner association, you'll also see another box. But what lender escrows for HOA if it's not a condo? Not very many, right? So you'll still see HOA because that is a monthly expense to your buyer, but that box will be checked no. So you might actually see $300 in that box right there, but $20 will be checked no because that's the HOA month, $20 a month or whatever, as an example. Yes. Same thing. If the lender will escrow for those things. Okay. Typically utilities though, all right, they don't account for that in any fashion here. So if they do have a monthly or annual MUD, you probably won't see that here, even if it does apply, because all utilities lenders leave that to the borrowers. All right, I don't like the next two boxes a ton. The closing fees you're going to see in just a second, and you'll see the total cash to close. Well, I mean, that is what it is. But go to page 2. Anybody have any questions on page 1? Anybody will? Okay. All right, on page 2. All right, so here's the fees. And this does look a little bit like the HUDs used to, but for all intents and purposes, box A, origination fees. Box A, B, and C are the fees that the lender is regulated on, okay, for services tied to the loan estimate they issued. So yes, if they quote our fees abnormally bad, okay, if there was a second appraisal they didn't account for on the loan estimate, if there was other unforeseen or just forgotten items they forgot to disclose, in conjunction with this, you'll see a lender's credit. So if along the way a second appraisal was ordered and your loan officer said, I'll pay for it. I didn't like that appraisal either. I'll pay for it. And you see, instead of $700, you see $1,000 or $1,400. You know, that's two appraisals. Before you get your blood pressure up and say, she told me she was going to pay for it. I'll show you in a second. There's 2 different spots a lender can give a credit. Okay. But A, B, and C, those are those fees from the loan estimate that the lender is regulated. So another thing with TRID, actually happened a little bit before TRID, but it goes on the same thing. Lenders have to be, they over disclose because they have to pay for any miscalculations, including my fees. So if they misquote my fees, because I'm in C, they have to pay. They can't even ask me to change it. They have to pay in the form of a lender credit or figuring out a way to pay the borrower for that miscalculation. So in this case, my fees, the survey and my fees were $2,400. If they quoted 1,000 and that puts them over that 10%, is it 10%?
10%.
That 10% allowance or, for overages, then Brandy is paying that fee or Will is paying that difference.
So she doesn't have E&O insurance.
She can make a claim on her E&O after the fact, but that is not going to help the buyer. I don't know that she does, and I doubt they can. But literally, her paycheck is going to have a $500 deduction for overdoing it.
That's why we over disclose.
That's why those loan estimates are over disclosed like heck. Just is what it is.
Right.
But just to kind of show you here, box A, those are what we call, or what TRID calls origination fees. Origination fees, if you've been to one of my closings, this is where I tell buyers, this is the cost of the loan in fees to the lender. So think of origination fees as money going to Guild, money going to the lender on the transaction, processing, underwriting, lock extension, tax service fees. Those are the things that are being picked up or being paid to the lender for their services. Okay. So what's the difference in that and B? Well, in B, you'll look very simply and see the payee, the appraisal is paid to even if the lender paid it and you're reimbursing the lender, it's still a service someone else provided. They pull a credit, they pay a credit, they pay for that credit report to a vendor. So they're passing that through to you. Same thing with C, even though they have to quote it on their loan estimate and be accurate, it's still a pass through. It's still being a vendor that is being paid, not the lender. So they're regulated on all A, B, and C, but the fees that are actually going to the lender in A, third party fees are B and C. Okay. And that's why I say they'll say borrower, you'll see in B and C, it says services borrower did shop for, or even borrower did not shop for. It doesn't matter. They're all required items for the transaction. All right. I've highlighted on line C07. So if you remember on that example, whoops, went the wrong way. On the example, the title policy or the mortgagee loan premium is $11.89. So you see that $11.89. Come on. You see that $11.89 right there on line C07, right? So remember $11.89. Just to finish going through page 2, the recording fees are in E. You'll see that's payable to Red River Title. I'm going to come back to that in a minute because just like what I told you about the lender, that's not actually our fee, even though it's paid to us. The prepaid, so F and G, okay, sometimes when you see crazy closing figures as a total, just know that F and G, those are prepaids. Those are items that go towards the property into the future that are really the buyers, their insurance, their taxes, things that aren't actual fees per se. They're not paying someone other than their insurance, but they're not paying someone for the cost of this transaction. They're being prepared for future fees, again, tax and insurance. There's also daily interest. Yes, that's also a future or a prepaid because you're pushing your first payment out to the first of the following month. So if you close today, your first payment would be December 1st, and that's because you paid per diem interest at closing today, which is $151 in this example. That makes your loan, that sets up that first payment to have interest in arrears. So that's a whole other topic that we could talk about. To Brandy. Just kidding. All right. So the escrow account, it's a good time of the year to have this class and talk about this. In this example, I'm charging 12 months. I'm not, the lender is charging 12 months of taxes, even though it's October and you're thinking, wait, taxes should be out, right? Well, they're not out in Grayson County because it's Grayson County. So the lender is collecting the 2020 taxes on this example. So taxes may come out tomorrow, but today they're collecting them to pay this year's taxes. So the buyer, yes, the buyer for the moment is being charged the entire year's taxes as an escrow item at closing. Section H, I should have put, for the sake of an example, I should have put something in there. Let's just say for the sake of this example, the home warranty, per the contract, the seller allowance was $500 and the home warranty invoice that you and your clients chose was $600. That's where you see that $100 overage, okay? If a new survey wasn't required, but your buyer just wanted a new one, this is where the lender would say, put it down there because they chose to do that on their own. Some homeowners insurance agents have an application fee. That's where you'll see it. Sometimes they don't pay their home inspections until closing. That's where you'll see it, pest inspections, those type of items. So those are the, let's say, less than traditional or kind of extras where they'll go to a buyer. Okay. Buyer's paying the buyer, buyer's paying their agent's commission. That's what you negotiated. That's where you're going to see it. Okay. By the way, you see seller fees, but we're not talking about them here because this is the buyer CD, right? All right. So everything I showed you, and let's go back up to line D. Because A, B, and C is what the lender is regulated, the total of A, B, and C is on line D. This is where the government kind of, I said this form is good, but this is where they kind of went wonky. All right. The total of E, F, G, H is on line I. So there's two different totals. Those two totals in D and I are then brought down to line J. Why? Who knows? Well, I know why. It's because D is the item that they are regulated on, again, on that loan estimate. Okay. All right. So in this example, the total closing cost in A, B, and C all the way through H is $9,433.07. Okay. So going to page 3, you'll see that number is carried over. Can you see my cursor? Will, can you see my cursor? All right. You'll see right here, that same number you saw on page 2 has been carried over to page 3. All right. So your debits for this transaction, and that sounds familiar if you've been to one of my closings, because that's how I say it. The debits for this transaction are the purchase price of $175 and the closing cost of $94.33. This loan is costing them $184,432.07. Okay. That $184,000 is now going to be offset going down here by their credits. They put up, in this example, $1,700 upfront, and now you see this combined. You may see it itemized separately. Really, it's kind of up to the lender. They prepare this. In this example, let's just say the earnest money was $15 and the option was $200. Now with the new contracts, sometimes that number is combined, sometimes it's still itemized. Doesn't really matter as long as your buyer gets the total credit applied to them, right? So in this example, they put up earnest and option of $1,700. They got that loan amount. Excuse me. That's the loan amount that's there. The contract paragraph 12 called for the seller to give a $3,500 allowance at closing fees. It is a line item credit here. I do run into some lenders, usually VA, where they itemize that $3,500 on page 2. If you run into that, just call me and, or your settlement agent if it's not me, and they'll run down where that $3,500 is. But for the sake of this example, it's itemized there. Now, next thing, I've highlighted it, right? Look at that credit. Page 2, right? That credit or that charge was $1,189. Page 3, right there, the credit is $1,089, leaving a net difference of $100 to the buyer per the simultaneous issue credit. The seller has now refunded, in essence, as a line item, the buyer's portion of the title policy they should not have paid. Does that make sense? Last item on this example, the seller is also giving a credit to the buyer from January 1st through our closing date of October 20th for their share of the taxes. So on page 2, the buyer paid into their escrow account 12 months of taxes, which was $2,100, right? But on page 3, the buyer received a $1,690 credit, almost $1,700. So the net difference the buyer paid towards the 2021 taxes is $400, which would be 2.5 months of taxes in this example. That makes sense? So it all shook out. Your buyer didn't pay all 12 months on their own. They got a credit from the seller. That's all good. So
I just realized how much our client really trust us, and for them to be reading it, you're going through it the way you do upside down real fast.
Yeah.
They're always nodding their head, and they never question it. And I'm sitting there going,
And I try to be thorough. What y'all couldn't hear is Donnie Neal said your borrowers really have to trust their partners, which is the lender, their agent, and us, because if you don't do this all the time, this is minutia. And I think you guys know the statistics better than me. I think the average buyer buys 3 houses, right? They typically stay in the house X amount of years. They upgrade once and then they upgrade a second time, and that's it. So, and if in this example, if your buyer last time they bought a house was 2010, well, they use a completely different format, not to mention all the other changes that have gone along with buying one, right? So there's a good chance this is the only one they may ever see. So, but Donnie had a good point. They really got to trust us. So, especially those title agents. Just kidding. So the difference in our credits, our debits at the top and our credits right there leave a net due from, is it not? It's very hard to see, but the box is checked from, okay? So net amount due from buyer of $8,800. So their down payment. So the difference in their loan amount of $167 and $175 plus the net difference in their closing costs leaves them bringing $8,802. Wire, cashier's check, y'all know the drill there, right? Real quick, because I skipped past it, If you did not, as the buyer's agent, did not get a loan estimate, up there at the very top, you'll see this is where, this was a new addition to, where TRID said, not only are we getting rid of the truth in lending, I'm going to make, and not only do the buyer, or excuse me, the loan officers need to give credits for miscalculations or underestimating, I'm going to give the buyer a chance at closing to see if the lender misrepresented it right there. Okay. And at the very top, so those are the figures from their loan estimate. In this example, okay, the lender, it's funny, they actually quoted a little bit less in closing fees on their original loan estimate, but they underestimated the credits, right? And so their bottom line was that they told the buyer they were going to bring, and their loan estimate was approximately 10,000, but they're really bringing 8,800. Because that loan estimate does factor in earnest money too. So that is factored in on both sides. So that loan estimate, you execute the contract on September 20th. They got a loan estimate on September 22nd. That loan estimate said, we have you bringing in approximately $10,000. Well, they came to the table with 8,800. So the loan officer got pretty darn close and better in their favor. Okay. Page 3. So page 4. Not a lot on here that is of great substance. Matter of fact, I would venture to say this is the least looked at page on the closing disclosure. Real quick, can this loan be assumed? No. Only on VA loans do you see where that first one's checked. There's not a demand, but your note has a lot of demands. Anyway, not a lot on here. You already know there's an escrow account. We've already gone through it. And you know there's only 1 year of escrows because they're not going to escrow 5 years in advance, right? So read through it. Not a ton of stuff on here that you don't already know on the first 3 pages. Okay. Page 5. This page is more important than people realize. First, the box at the top. Okay. This is the truth in lending. This is the form that stopped people in their tracks. This is also the form that up until about 18 months ago was a little more alarming than it is now, because interest rates are so low that second column, finance charge, is a lot less intimidating than it was when interest rates were 4.5%, 5%, 6%, 7%. So the total of the payments, this loan for $167,000, if your buyer makes 360 consecutive payments on time, doesn't pay any extra or early, refinance, sell it, their total payments will be $252,649. This loan cost them $82,000 over the life of the loan in interest and fees. Okay. So this is the one that used to stop everyone down. Real quick, maybe 1 out of 40 buyers ask me what the APR is. Again, this is the old truth in lending. So this is the one that stopped everyone in their tracks. That APR, okay, is literally annual percentage rate. So this interest rate of 2.75 in this example, well, in 2020, the buyer actually paid the lender 2.9%. They paid him 2.9% because they had $8,000 in fees. So in and above their monthly interest on their loan, they paid fees. So that number will be closer to 2.75 in the future years, assuming they don't have late fees, they don't have other transactional fees with their loan. But it is higher here because they paid fees. That's really what it boils down to. And you'll notice also the amount financed is usually a little bit less, but in this example, I just rolled with it. The other thing that's important on page 5 is, because this is the form that you all keep, right? You give it to your broker, you keep it in your file. This is the one that we put with your paycheck, right? Page 5 is important because there's your contact info. So if you're working with a buyer, if your buyer calls you in 5 years and you've switched brokers, or you have a new email domain, and you don't have a copy of this, but they do, or your buyer's lost it, but you kept a copy of it, where did we close? We closed at Red River Title. It says so on page 5. What was the, oh, you're thinking about buying again? Who'd you use last time you financed? I used Michelle Castle. Well, there's her info right there. Let's call her. Okay. There's also the agent's info too. So if you're representing a seller, you may be able to see who their agent was when they bought it, because you're looking for something or need some assistance. Anyway, so page 5 is important too. Any questions? So again, everything we just went through is prepared by the lender. It is prepared in conjunction, and you'll hear the term balanced with the title company because they typically, that final one is not issued until they're balanced with us. That initial one may not be balanced with us, but the final one will be. This is also the form that you hear that undoubtedly your buyer gets it and thinks everything's ready, or and tells you everything's ready. I got the closing disclosure. Okay. We're not lying to you when we say we don't have docs. It just, this goes out because it has to. That doesn't mean the closing docs have gone out. It doesn't mean it's balanced. Okay. All right. Any questions on the buyer's closing disclosure?
What's the deal with the bottom?
Okay, so you paid 200, see the top line, you paid $252,000 for this. So 47% of that number is the 80,000 you paid in finance fees. As a point of reference, for whatever it's worth, this is not what this class is about. 5% over 30 years is about 110%. So in other words, this $167,000 loan, they pay back about $345,000. So more than the principal ever was. So 47% or almost half of the total of the payments is interest, is still infinitely better than where we were in 2010, 2012, that range. Okay. Good question. Eli asked, what is the 47% right here? And that is a percentage of how over the course of 360 payments, when the buyer paid 252,000, 47% of those total payments went to the lender in interest. So that's the question he asked.
2.92%. So you said
Because you paid, so now he's asking me to clarify what the 2.9% is. This loan had, in lender fees, it had, lender required fees. So not all loan fees, but lender required fees, it had approximately $3,000 in fees. So you paid your buyer, or excuse me, you as the buyer paid to your lender 2.75 over however many payments you made. Even if you only made one, you paid them a 2.75% interest on the principal, okay, on that payment. But you also gave them, the buyer gave the lender $3,000 in fees as a part of the closing. So the lender received, in addition to the 2.75, they received payment of fees.
And basically that's-
Theoretically, yes. I would direct you to Brandy Squires, Will Bennett, and Michelle Castle on further
Yeah,
clarification.
it's very.
Again,
confusing, but it
For
does-
you on the Zoom, we're clarifying the APR.
It
for
does
some
take
here.
into account the fees. So I always tell everybody, just look at the interest rate. What are you paying? 2.75%. But the 2 whatever it is.
2.9.
2.9. Yeah.
Yeah.
Just trust,
Okay,
trust.
And but seriously,
It's very confusing.
but seriously, we're still talking about it, guys. But seriously, you asking that question, now imagine a buyer sees that at the closing table, right? And the way it used to be was a legal size paper in bold, you paid 2.9%. Whoa. And that's the first time, and right here's the only time they see how much this loan cost them. So also before trade, we had higher interest rates. So imagine when they saw that they paid back nearly $400,000 for a $167,000 loan, you can imagine why closing stopped. And many times, I wouldn't say they canceled very often, but they definitely stopped. There was a lot of sweat pouring, a lot of tears being shed. Like, are you blanking serious? That happened. So anyway, but that being said, the rest of this form, the reason it's on page 5 is the rest of this form sets you up for that. Whereas springing it on you without much assistance or warning of why is the reason we're here, the reason we're talking about it. All right. The rest of the way is easy. Selling disclosure. Selling disclosure is usually 3 or 4 pages long. It's prepared by the title agent, but you hear us, you're the listing agent, you're representing sellers, you're saying, why can't you send us a seller CD? Because our CD has to balance with the lenders in order for the sellers to be final. Well, what's going to change? Well, I don't know what the recording fees are. I don't know what the attorney invoice for the deed is. I don't know if tax prorations are going to change. Okay. Those are some of them. Yes, we could probably get you a seller CD. We could probably get you a seller CD halfway through the contract that it's going to be an estimate. But we typically, for the same reason I told you I don't like to send them out to buyers. The minute you start sending 100 different versions, it just adds confusion. If we're getting down to the wire, yes, we'll send out and we'll say, hey, this may change by $100. You know what I mean? But we prepare them. They're prepared in conjunction with the buyer CD. And just to pull back the curtain, our system, our software, and every title company's software is essentially a lender's closing disclosure too. But we're subject to them giving it to us first. So anyway, the seller CD almost always will come from the title agent to you guys as the listing agents, right? So here's an example. Same thing at the top. You have the info. What you saw on page 5 as far as interested parties, you now see on page 1 over here on the right. We have our buyer's agent on the top, our listing agent in the middle, and then the settlement agent there. You don't see the lender on this because after you walk away from this property, you don't care who the buyer's lender was. And Trid, believe it or not, was smart enough to know that. In this case, on the last closing, on the buyer's closing disclosure, the debits were at the top and the credits were at the bottom. This is the balance sheet. Again, pulling back the curtain because my closing disclosure is the same. On the back side, what you don't see. So here, the credits are at the top and the debits are at the bottom. It is a balance sheet. You have debits, credits, debits on a master version. Sales price. In this example, this closing disclosure is based on that buyer's one we just went through. So same thing. The listing, the sales price is $175. The total debits, again, is so weird. I don't know why it didn't show up on it. Oh, it did show up in here. The total of the fees is at the top. Don't ask me why. So that 118,090, I know it's hard to see, but that's what that says here. That's a total of these things right here. So you have the closing fees right here, 11,811. You have, the payoff. That same line item credit you saw on the buyer CD for 3,500. Here it is in the seller CD. The seller is now paid to the buyer. The seller concessions per paragraph 12. Okay. Here is that credit from the seller to the buyer for that title policy for the lender or for the buyer's portion that they paid to their lender or as part of lender fees. So now the title policy, part of the title policy of 1089 is here. But I showed you on the other earlier screen that the total is 1,227. So where's the rest of it? Well, I'll show you. So the prorated taxes are there. That's the same credit. It's like the seller concessions you saw on the buyer CD. Now it's a debit to the seller. They have paid their share of the taxes today. They're done with taxes. The buyer needs to pay it. We could talk about the paragraph 13 of a track contract with prorations later in a different class, but they've paid their share of the taxes here. So these debits from the sales price leave a net. I know it's hard to read, but this seller is getting $56,000. Page 2. So here's the fees. I get questions all the time. How come? Why do I see Guild's fees? Well, you don't see them in the column. Or down here, how come I see the escrows? Well, you don't see them. Again, pulling back the curtain, our system is the lender CD. We just print a seller version off there. So some title companies, most of the ones here use the same version we do. I know they use the same software. Some title companies in the Metroplex, they use what they call seller statements. And it's only meant to simplify of this very reason. So you don't see that this buyer had picked Allstate. You don't see their amount, but you can see they picked Allstate. Or you can see that the lender collected 12 months taxes. But in the column, you can't see my finger. In the column is the fees. All right. So the seller has a doc prep fee of 150, and here's the title fees, right? Scrolling down here, they had a home warranty they agreed to pay. You're a listing agent. That says 500 or less. Your seller was agreeing to give up to 500. You're good there, right? You may know as a listing agent that the invoice was 600, but you only see 500. That's all you care about because that's your seller allowance amount. There's the commission. Did you forget to tell me that you're charging 2% for the listing side? Here's where you're going to look and tell me. Okay. I highlighted the wrong one. Well, we could talk about it anyway. I meant to highlight the bottom one. So that 138 is that difference of that. So the 138, the very last item, that plus 1089 is that 1227 I showed you on the earlier screen. The total title policy for 175 is $1,227. So your seller paid $1089 plus $138 And that's that's the full title policy that the seller agreed to pay for the contract. What I accidentally highlighted is the paragraph 688 owner's policy endorsement that in this case, the seller also agreed to pay. And that's itemized separately. If the buyer is paying it, you'd see that same item for the same amount on the buyer side. So the total fees of 11,811, going back to page 1, you saw it carried over there, right there. Any questions on the seller CD? Or just a signature page? Will, any questions on the chat or anything? All right, real quick, I'll just zip through this last thing. So listing agent gets seller CD, buyer's agent gets buyer CD. But what if you need to make sure there's a broker here in town that when they represent the buyer, they need the ALTA. So in Trid's infinite wisdom, Texas said, we're Texas. So they wanted a uniform version. So there's an ALTA settlement statement and a Texas disclosure. So we didn't really have less forms when it's all said and done. We have more forms, but they're easier. The ALTA, which you guys would rarely ever see, is a required item by lenders and Texas title companies, but I think all title companies. It's really, some lenders actually refer to it as the disbursement settlement statement, because that's where everything's merged together, buyer and seller side. This is the most common reason a buyer's agent would want an ALTA. If you charged if there was a 4% commission, the lender always defaults with 6. Well, I charged the right amount, but the lender CD shows that you were paid 3% and you weren't, and your broker doesn't want to see that you were paid 3% because that's what that says. The ALTA will show what we actually pay because I can't give you the seller. Does that make sense? So, or if you're representing a buyer and the seller fee, you want to see the seller fees, the ALTA is the one that does it. That's also prepared by us and issued by us. So this is an example. For those of you that remember HUDs, it looks eerily similar to a HUD, and it is a HUD. You'll see there's a seller column, there's a buyer column. Really, the only thing that is any different, like right here, you see the seller concessions and the taxes. Those line prorated items right there, right? There's the loan fees. On the next page, whoops, I went too far. It's interesting here. So the total title policy is charged to the seller at $1,227 there. This is where you know your seller or the seller was charged the right amount. Last item, the Texas disclosure. If you ever hear from us, hey, I need your CDA. I'll get it to you after closing. Oh, we really need your CDA. In Texas, this has been since I've been in the business, we have to disclose anyone we're cutting a check to, even if we don't disclose the amount. So if you work for Paragon, if you work for Remax, if you work for Better Homes and Garden, and you have CDAs, and we want to make your check payable directly to the agent, that's the reason we're asking for CDA, because the Texas disclosure says we need to tell all the parties that we gave the agent a check. But don't tell them the amount. Anybody. Nope, nobody else has to know the amount besides us, but we have to say we cut a check to somebody. Same thing with the recording earlier where I told you it's not really our fee. So the Texas disclosure, whoops, hit the wrong button. The Texas disclosure says, by the way, the first page of Texas disclosure, there's the total premiums again. So if you actually want to see the total premiums, it's on the first page of the Texas disclosure. We don't give it to you out of practice, but you can certainly ask for it. Okay. There's no reason for you to have it unless you just want to see it. Your buyer signed, all parties sign it at closing. There's the total title policy. And on the next page, this is where we tell, if you look at the very top, the agents in my example were Maureen and Tracy. And so we cut them a check. That's all you need to know as the people participating in the transaction. We cut them a check. You'll also see the recording fees. We have to tell you that we charge those recording fees, but we actually gave them to Grayson County. So we're disclosing that to you. That's it.